So learning objective 2 in chapter 3 introduces you to what an account actually looks like, right? Um, and so this particular illustration is what every account looks like. Okay. So you've been learning all different types of accounts, right? So you learned about cash and accounts receivable and supplies. You've learned about equipment. You've learned about accounts payable. You've learned about common stock and retained earnings. You've learned about revenue and you've learned about expenses and individual accounts specifically, right? So all of them look like this. So the title of the account would be the exact title of the exact name of the account, like cash um, or common stock or service revenue or rent expense. That would be the title or the name of the account. All accounts have two sides. A left side that we technically called a debit side, and a right side that we technically call a credit side. But all it really means is two sides, the left side of an account and the right side of an account. What I need you to do is I need you to forget about how you learned these terms, debit and credit, up until today, okay? Because all you've learned about a debit and a credit, it probably came from a bank, all right? And your understanding of banks. Um, I'm not teaching banking, right? I'm not teaching that side. We're learning it in accounting. So in accounting, these words mean different things than what you learned personally about the terms, okay? So in accounting, you have to retool your mind. Debit is simply the left side of an account. Credit is simply the right side of an account. And if this is confusing you, I need you to think about two things. The first thing I ask you to think about is a coin. If you tossed a coin, if you looked at a coin, you will see a coin has two sides. There's heads, right? And there's tails. So when you flip a coin, only two things can happen. It's either going to land heads or land tails. Like an account, only two things can happen in an account. You either have more of something in the account or you have less of it. So the second thing I want you to think about is your own savings account. Okay. Only two things can happen to your savings account at a bank. You either put more money in or you take money out. So either you have more money in your account or you have less money in the account. In essence, that's the only thing that can happen to all accounts, regardless of their title. So regardless of whether we're talking about cash or accounts payable or retained earnings, what have you, only two things can happen in those accounts as well. You're either going to have more of them or you're going to have less of it. Okay. There's just no other way. An account just has two things going on. You have more of it or less of it. And so accounts work with two sides. One side represents more of something in an account, and the other side represents less of something in the account because only two things can happen in the account. You can either have more of it or less of it. That's it. Okay. The trick here is to understand that accounts work differently. So asset accounts, for example, and let's just pick on cash because that's a very important and active account. Cash is the title of an account. Now, to show we have more cash, we would put those figures on the left side of the debit side. So everything that happens on cash on the debit side of the cash account, to bookkeepers and accountants, it just tells them we have more cash. Well, what if we had to use cash? Well, that's what the right side of the cash account tells us. Every time there's a number on the credit side of the cash account, it represents less cash, right? Cash going out. Right? So that's the only thing that can happen. in an account. You're going to have more of it or less of it. So that's what the two sides represent. Okay. So for asset accounts like cash, supplies, prepaid insurance, equipment, the left side or the debit side of all of those accounts are where we put the numbers if we have more of it. The right side or the credit side of the account is where we put the numbers if we have less of it. So that's how assets work. And you're going to see this over and over again. Liabilities and stockholders' equity work the opposite. They're on the opposite side of the balance sheet, and they have opposite sides of the account that they look at as more. So for a liability account like accounts payable, if you have more accounts payable, and that's the name of the account, well, in accounting, we would put those numbers on the credit side to indicate we have more accounts payable. So you would see the numbers on the right side or the credit side of the account as showing we have more, say, accounts payable. We have more bills to pay, right, in 30 days. As we pay those bills, we reduce it on the opposite side, which for a liability account, like accounts payable, that's the debit side or the left side. We use debit and credit all the time in accounting, and this is the terminology you're going to learn today that will be with us for all of the days that we'll be learning accounting. Not just in financial accounting, it continues on into managerial accounting. So it's just that all accounts have two sides, and you have to label the side what it is, right? So again, I need you to forget what you learned about these words, the word debit and the word credit, because in accounting, debit simply means the left side of an account. Credit simply means the right side of an account. All accounts have two sides because only two things can happen in an account. You can either have more of it or you can have less of it. I need you to think about it in those terms, okay? So that's the beginning. That's the beginning. Let me scroll down a little bit. Let's take a look at cash here. Because in this case, we had a whole bunch, and I'm making it a little bit larger here. We had a whole bunch of activity in the cash account for Learning Objective 1, right? And we saw those 11 events happen to Sierra Corporation. Many of those events affected cash. And so you were busy putting pluses and minuses or watching the pluses and minuses in the column there. But again, the plus simply meant that we have more cash. The minus simply meant we have less cash. Now, cash is an account that has two sides. So here you have it in the account form on the right. The left side of the cash account shows where we have moments in which we had more cash. So that's the debit side of the cash account. The left side of the cash account is where we put the numbers to indicate we have more cash. The right side of the cash account, which is the credit side, these numbers show when we have less cash. So they correspond with the numbers that you learned about from Learning Objective 1. Every time you see a positive number indicating more cash, those would be listed on the left side of the account because the debit side of a cash account shows more. Okay. And again, only two things can happen to cash, either have more or less. That's it. Okay. It's that simple, really. The hard part is understanding the more side of cash is the debit side. The less side of cash is the credit side. That's what you're really kind of getting used to here. Okay. But you will catch on. This does take a little bit of study. This is the language of business, and the language, you're learning a new language here in accounting. Okay. Debit and credit is part of the language that we use, and we'll be using it forever. So this is the time that you need to really kind of focus on this. All right, so for the account itself, every time there's more cash, those numbers show up on the debit side of the cash account because the debit side shows where we have more. Where you saw all the cash being used for paying for things, those would actually be on the right side of the cash account because the credit side of the cash account, that right side, is where we show less cash. So this is just an example of how those accounts would work. Okay. So this is the thing for today. All accounts are the same. There's a title to an account, and only two things can happen. You're either going to have more or you have less. So every account has two sides. Okay. It really becomes that simple. The trick to this part of the chapter is understanding what the sides do. Right. Because the debit side of asset accounts is where we show more, which means the other side of the asset account, which is the credit side, all accounts have two sides, just like the coins. If you're looking at the heads, what's on the other side? The tails. Same thing, all accounts. If you have a credit side, you have a debit side. All right. The credit side of a cash account, for example, shows less. So this is a big part of what you're going to be doing. Let's go to the PowerPoint and continue our discussion here. It'd be nice if I got to the right place here. Okay, so we're going to actually come back to all that stuff in Objective 1 because I'm going to actually have you read it a little bit. All right, so what you have to know here is that accounts have two sides. A debit side, which is the left side of an account, and the credit side, which is the right side of an account. All accounts are structured with two sides. Okay. And we use these terms, debit and credit, in accounting to indicate what side of an account was affected. We never throw pluses and minuses at each other. We only throw debits and credits at each other. Because if we know what side of the account does what, okay? So one side of the account increases it, the other side of an account decreases it. So we don't have to throw pluses and minuses. All we need to do is throw debits and credits, okay? So these terms are very, very important to learn. And remember, from Objective 1, at least two accounts are affected by every transaction, right? Which means, in essence, after every transaction, you're going to have an equal debit and credit. So one account is going to be affected on the debit side, and the other account that you identified is going to be affected on the credit side. So everything is going to equal out. So as you identify those two accounts that were affected, guess what? One account's going to be affected on the debit side, the other account's going to be affected on the credit side. That's another thing I can guarantee you, okay? So this is another thing you kind of have to know, right? We're going to debit one account, we're going to credit the other account, okay, for every transaction. Now, this is just an example. I'm going to go ahead and cross out the account name and actually make this cash just as an example here. So again, whatever the account name, and you've known what the account names are now, this is where it would be. And again, all accounts have a credit and debit side. Now, you'll see the DR as an abbreviation for the debit side. I think this goes way back to either the Italian or the Latin of the root word of debit. And credit, you'll see it abbreviated off in the CR. But either way, all accounts have two sides. So here there's a bunch of transactions that happen. You'll see that there were two debits to cash, one credit to cash. All you need to know is every time there's a debit to cash, there's more cash. Every time there's a credit to cash, there's less cash. So in the end, basically, we're looking at it in an aggregate. So we can look at it, there's $18,000 went into the cash account. That's these two added together. And 3,000 going out of the cash account. So one side, the debit side, is bigger than the other side, the credit side, by $15,000. So that's the balance in this account. This account has a $15,000 debit balance. Why? Because it had $18,000 of debits and 3,000 of credits. The difference is $15,000 on the debit side. The debit side is bigger than the credit side by 15,000. So that's where the balance goes. And that would make sense if I asked you what your balance was in your savings account. You wouldn't say, well, I put $18,000 in, I took $3,000 out. You wouldn't say that. You would just say, I have $15,000 in my account. That's how we talk in accounting. Right? So that's really important to sort of understand how this works. Okay. And there's a few slides here that go on. I'll just do another one with you here. So this here is an account where the credit side had more activity on it than the debit side. Well, this would be something like an accounts payable. Okay, so I'm just going to abbreviate AP because I can't really spell all this stuff out with my finger. So this is the accounts payable, which is a liability account. Liability accounts are on the other side of the balance sheet, so they increase on the other side of the account. The credit side of the account shows more accounts payable in this case. The debit side is when we pay those things, it goes down. Okay, so again, only two things happen in an account. You have more of it or less of it. That's it. It's that simple, right? You just have to understand what side represents more, what side represents less in every account. Okay. So here we had $11,000 of credits in the accounts payable account, 10,000 of debits. So the credit side, there was 11,000. On the debit side, there was 10,000. So the balance is, or the credit side is larger than the debit side by $1,000. So the balance in this account would be $1,000 credit balance in the account, because this is on the credit side of the account. So that would be its balance. Okay. Again, this is how it works. And again, you're just getting introduced to this type of stuff, and that's why I've given it to you today so you can practice over the weekend. It's critically important that you understand this. So for assets, all asset accounts, and you know them because you've been working on that class 5 balance sheet, so you know those assets for sure. All asset accounts work the same way. If we have more of the asset, we show it on the debit side. However, if we have less of that asset, we show it on the credit side. Okay. So that means that when we talk about assets like cash or supplies, and we get asked the question, what's the balance in the account? The balance is always going to be on the bigger side, which is for assets, the debit side. So all assets have what we call a normal debit balance, because the debit side of an asset account is where we show we have a balance, right? So that's very important to sort of understand. Assets increase on the debit side, decrease on the credit side. Again, you would have a specific account title here. So cash, supplies, equipment, they all work the same way. However, on the other side of the balance sheet, remember, assets equals liabilities and stockholders' equity. So in essence, that equal sign on the balance sheet flips the accounts. All liabilities increase on the opposite side of assets because they're on the opposite side of the balance sheet. So all liabilities where we show we have more of a liability, it'll show up on the credit side of the account. So I just showed you accounts payable. Accounts payable is a liability account. Every time we have more accounts payable, we would put those numbers on the credit side of the account, showing we have more. When we paid those bills, we would lower it by putting it on the debit side, showing we have less accounts payable to pay. Okay. just the opposite of the asset side. Very much like the balance sheet, right? Assets are on the left side, and guess what? Assets increase on the left side. On the right side of the balance sheet, you have liabilities. Guess what? Liabilities increase on the right side of their accounts. So you can always think of that balance sheet when you're thinking about, okay, how does this account increase? So that's just a little trick, perhaps, maybe not. Of course, as we learned from the last objective, there's a lot going on in stockholders' equity, particularly retained earnings, right? Particularly retained earnings. But in general, stockholders' equity works the same as liabilities. Okay? It's on the right side of the balance sheet. So guess what? The right side of a stockholders' equity account shows we have more. To decrease a stockholders' equity account, that's what the debit side is for. Every account has two sides. One side increases the account, the other side decreases the account. That's the only two things that can happen in an account. You either have more of it or less of it. Okay. So common stock is a stockholders' equity account. You're almost just going to see the credits going on there, because every time there's stockholders, we're going to show that on the credit side of common stock. Retained earnings is a bit more complex because, as you learned from the last objective, retained earnings includes revenues and expenses. In other words, it includes net income. It also includes dividends. Right. So retained earnings is slightly more complex, just like it was earlier on in the last objective. Retained earnings will increase on the credit side. So anything that adds to the profitability of the company, revenues in essence, will be showing up on the credit side of retained earnings. But what does that mean about expenses and dividends, which you know decrease retained earnings? Well, they would show up on the debit side, right? So if you just looked at the individual account for dividends, you would see that more dividends happen on the debit side, because when they get transferred to retained earnings, the debit side shows less retained earnings, which is what we do with dividends, right? We subtract it out of the retained earnings. So in essence, dividends show up on the debit side because they reduce retained earnings. More dividends means less retained earnings. Of course, the same is true on the income statement, right? Revenue is where the profit is. So revenues increase the retained earnings of a company. So all revenues are going to show up on the credit side, okay? Because this is where the excess revenue is the net income. And that's going to go to benefit the retained earnings of the company. However, expenses, as you know, decrease retained earnings. They decrease the profits of the company. So all expenses will show up here on the debit side. Because the more expenses you have, the less retained earnings you have, the less profit you have. Okay. So that's something that you're going to need to look at. So there's a bunch of debit and credit rules. That's okay. This is my favorite illustration in the book, because I think it is very, very helpful to have it. And so here they show you the basic equation: assets equals liabilities and stockholders' equity. But then you know that we expanded stockholders' equity to include the income statement and the retained earnings statement, right? And so when you expand it and you look at all of the accounts, asset accounts always increase on the debit side. Every time we have more assets, we're going to show that on the debit side. When we have less assets, whatever it is, cash, supplies, credit side of the account. Liabilities, we show we have more liabilities on the credit side. As we pay those liabilities down and we have less, we show that on the debit side. And then, of course, again, common stock, retained earnings, revenues, all positive things for the owners. So they will show up on the credit side. However, expenses and dividends take away from all of that. So how would we shrink retained earnings? The debit side. So these are important rules that you need to learn. And there's going to be a lot of questions about that on your homework coming up. Okay. So let's take a quick break and ask if there's any questions right now. All right, we're going to do an exercise uh, with the previous objective, learning objective 1. And what I want you to do, and I'm going to be asking volunteers simply by reading the names on my attendance list here, just to give it a chance. I want you to practice talking like accountants. Okay, you're going to practice talking like accountants, and this is the time that you're going to make the mistakes. It's fine. But I want you to practice, because the more we practice this, the more it's going to click. Like, oh yeah, I get it. Okay, so you up to it?